Welcome to our deep dive on turning trust distributions into long-term growth. In this video, we will transform a one-time windfall into a sustainable strategy that prioritizes safety, tax efficiency, and compounding. To begin, we will start with immediate liquidity moves, then transition into a clear investment priority hierarchy, and finally address complex relationship and risk considerations. Stay with me until the end for key takeaways and a practical checklist to put this into action. Here is our roadmap. First, we cover why securing liquidity immediately is essential. Next, we walk through the investment priority hierarchy, including skills and education, tax-advantaged accounts, and taxable brokerage strategies. Then, we examine the controversial decision regarding partner debt and property. After that, we reinforce debt and credit foundations. Finally, we finish with an action checklist, a couple of quizzes, key takeaways, and a concise summary. Let's move in order to build momentum and clarity. Before we start, a quick but important disclaimer. This video is for educational purposes only and is not financial, legal, or tax advice. Your situation is unique, and laws and tax rules vary by jurisdiction. Therefore, you should consult a licensed fiduciary financial advisor and a tax professional before making decisions. With that said, let's move into immediate actions you can take safely while you plan. First, time is value. A large distribution sitting in a standard checking account is effectively losing purchasing power to inflation. Therefore, immediately move cash into a high-yield savings account or laddered short-term Treasury bills. The goal here is to combine safety, liquidity, and a competitive yield while you finalize a long-term plan. This preserves your options and prevents opportunity cost without forcing premature investment decisions. Now that your capital is safe and earning, we can shift to the priority hierarchy for long-term growth. With liquidity secured, structure your plan by priority. First, invest in yourself through high-impact skills, certifications, and career moves that increase earning potential. Second, maximize tax-advantaged accounts such as traditional and Roth-IRAs. Consolidating old accounts onto a low-cost platform simplifies management and reduces fees. Third, with retirement channels optimized, direct excess into a taxable brokerage, and emphasize low-cost, broad market index funds for long-term compounding. Finally, maintain a liquidity buffer to prevent forced selling and to keep flexibility. Next, we will unpack each layer briefly. Education and skills can outperform markets because they directly raise income, which powers every other part of your plan. Focus on credentials and capabilities that are recognized in your industry and that improve your negotiation leverage. Allocate a deliberate portion of the distribution to courses, certifications, or coaching with clear return potential. After completion, negotiate compensation or role changes to capture the increased value. Now that we have boosted earning power, let's optimize for taxes. Next, capture tax benefits that compound over decades. Maximize traditional and Roth-IRA contributions each year if you are eligible. Roll over and consolidate stray retirement accounts into a single low-cost platform to reduce fees and simplify rebalancing. Automate contributions and allocate to diversified, low-cost index funds. Tax efficiency here amplifies compounding by deferring or eliminating taxes on gains, which can materially affect long-term outcomes. With tax shelters addressed, we can direct surplus to a taxable brokerage. In your taxable brokerage, emphasize broad, low-cost index funds rather than targeting high dividend yields. Yield chasing can increase tax drag and concentration risk, whereas broad market exposure with low expenses tends to compound efficiently. Enable automatic dividend reinvestment to keep money working continually. Maintain a decades-long mindset and avoid reacting to short-term volatility. Next, we will address a sensitive but crucial topic: partner debt and property. Here is a critical comparison. On the left, using your personal funds to directly pay a partner's debts or to make principal payments on a property you do not own exposes you to recovery risk if the relationship dissolves. Equity in an asset titled to someone else is difficult or impossible to reclaim. On the right, a safer alternative is to temporarily shoulder a larger proportion of shared household expenses. This frees your partner's cash flow so they can accelerate their own debt repayment, achieving a similar household outcome without jeopardizing your principal or independence. Now, let's shore up core financial foundations to support all of this. Your base matters. Maintaining zero personal debt and an excellent credit profile keeps your cost of capital low and your options open. This foundation ensures that future distributions can go straight into investments instead of servicing past obligations. With the base reinforced, we can visualize how to stage your capital while planning. This pie chart shows an illustrative split between a high-yield savings account and short-term Treasury bills while your long-term allocation is finalized. This is an example, not a prescription. Your exact mix should reflect your time horizon, risk tolerance, and any near-term needs. The emphasis is on preserving liquidity and safety while earning a reasonable yield. Next, let's consolidate rules of thumb into an actionable checklist you can follow. Follow this sequence to operationalize your plan. First, move funds to a high-yield account and consider a short Treasury bill ladder. Second, shortlist skill investments with timelines and expected returns. Third, max out eligible IRA contributions and consolidate old accounts to reduce fees. Fourth, open or optimize your taxable brokerage, automate contributions, and enable dividend reinvestment. Fifth, define a target asset mix appropriate for your risk tolerance. Sixth, coordinate household expenses in a way that protects your capital without paying a partner's personal debts. Finally, schedule periodic reviews to stay on track. Now it is time to test your understanding with a quick quiz. Question: what is the best immediate move for a large cash distribution while you finalize your investment plan? Option A: leave it in a checking account to stay flexible. Option B: move it to a high-yield savings account or short-term Treasury bills for safety and yield. Option C: buy high-dividend individual stocks for income. Option D: pay down an unmarried partner's mortgage principal. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is moving funds to a high-yield savings account or short-term Treasury bills. This preserves liquidity, protects principals, and captures a reasonable yield while you finalize your long-term strategy. Now, let's try another scenario about partner-related financial decisions. Question: before marriage or legal co-ownership, which approach reduces risk while still helping the household financially? Option A: pay down your partner's student loans directly. Option B: cover a larger share of shared household expenses temporarily. Option C: make lump sum principal payments on a house titled to your partner. Option D: co-sign new debt to consolidate your partner's obligations. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to cover a larger share of shared household expenses temporarily. This approach supports the household while keeping your capital protected and avoids the legal and recovery risks associated with paying a partner's personal debts or a mortgage on a property you do not own. Next, we will reinforce concepts with a quick reference table. This table summarizes common account types. Traditional IRAs provide tax-deferred growth with taxes due at withdrawal. Roth-IRAs offer tax-free growth and tax-free qualified withdrawals. Taxable brokerage accounts are fully flexible but subject to dividend and capital gains taxes, often at long-term rates if held over a year. With these differences in mind, let's visualize the long-term journey of compounding. This timeline illustrates how consistent behavior compounds over decades. In the first years, secure liquidity, invest in skills, and automate tax-advantaged and taxable contributions. Over the next decade, maintain discipline and rebalance with a preset cadence. In later decades, let compounding work while you prepare for major goals. Automation and low costs are the backbone of this journey. Next, let's add a quick Markdown reference to cement the priority order in your notes. Here is a Markdown formatted priority checklist you can copy into your Notes app. It reinforces the order of operations. Secure liquidity, invest in skills, maximize tax-advantaged accounts, build a low-cost diversified taxable portfolio, maintain zero personal debt and strong credit, and structure household contributions to protect your capital. To close, we will highlight the key points and wrap up with a concise summary. These are the essential points. Secure liquidity immediately. Prioritize skills for outsized returns. Maximize IRAs and consolidate accounts to reduce friction. Use low-cost broad index funds in taxable accounts for long-term efficiency. Protect your capital by structuring household expenses wisely rather than paying a partner's personal obligations. Maintain zero personal debt and excellent credit. Finally, automate contributions and conduct regular reviews. In summary, protect cash and earn a safe yield while you plan. Invest in yourself first, then maximize tax-advantaged accounts, and finally compound in broad, low-cost index funds. Protect your capital structure in relationships by adjusting shared expenses rather than paying partner-specific debts. Over decades, let time, low costs, and automation carry the load. Thank you for watching. If you found this valuable, please like the video, share it with someone who is planning a big financial decision, and subscribe for more practical wealth-building frameworks. What will you do in the next 7 days to move your plan forward? Tell us in the comments so we can cheer you on.